trading and don't know this. Right? We just got all that BS out. Just focus on what is important. Nothing else matters. Nothing. We're going into the market. The market is Forex. We know the reasons why we want to trade Forex. It's a great market. And we want to build a trading strategy. And that trading strategy will have these three components. Trade entry, trade exit, and trade recovery. Now, trade entry. Over the years, I have developed a very simple way of looking at a market and knowing 4 out of 5 times, 3 out of 4 times, every single day, which direction the market is going to go. Do you think that would be helpful in trading? If you could predict with 75 to 80% accuracy which direction the market was going to go each and every day, would that be helpful to you? Absolutely. Would you like to know how to do it? Absolutely. Of course. Well, it's very, very, very simple. Now, do you think your trading results would improve if you knew which direction the market was going? Well, no, obviously, right? How do we do that? Well, this is a daily chart that I use, and this is a Heikin Ashi chart. Heikin Ashi chart is slightly different than your standard chart, your bar chart, or your candlestick chart, or any chart you might be using. When I look at the market, I only look at it as a Heikin Ashi price illustration. Nothing else. I don't look at anything else. I don't look at the standard charts. I don't look at candlesticks. I only look at Heikin Ashi. Heikin Ashi is somewhat similar to candlesticks, but it is different because it's a lot more smoothed out, and it illustrates the trending a lot clearer than any other chart would. So to start, basically, looking at the market, I would eliminate any and all charts except a Heikin Ashi chart. Because the Heikin Ashi chart, as you can tell from this illustration, you see how nicely it shows you the trend. Green, prices going up. Red, prices going down. So, when I was going through all these different various types of charts, particularly on a daily chart, I discovered a pattern that statistically repeats itself 75 to 80% of the time. And you know what that pattern is? It's very simple. How do I predict the direction of the market today? Based on what the market did yesterday? Well, I just simply assume that the market is going to do the very same thing today that it did yesterday. Now, you can show me any currency pair, any time period on a daily chart. I will show you how this pattern holds true every time, all the time. So look at it. Look here. Let's just start as this is our basis, right? The first bar. First bar, the day. This is a down day, right? The market's going down. Red bar. And I'm going to assume that the next day is going to be the same as the previous day. That's it. Just simple as that. Nothing more to it than that. So here we are. This is a down day. Next day is going to be a down day. Next day is going to be a down day. And even here, because I at this point, I do not see what is in front of me. I don't have the benefit of a hindsight. Right? But I'm going to assume that the next day is going to be a down day also. But guess what? I'm wrong. No big deal, I'm wrong. But now you have to update. Next day is going to be an update. And then update. So I'm right. Here I'm wrong. I'm wrong again. But I'm right. I'm wrong, right, wrong, right. Wrong, right, wrong, right. This is really nothing. This is wrong, right, wrong, right, wrong, Three out of 4 times, 4 out of 5 times, I'm right. Right? Now, can I be wrong? Yes, I can be wrong. But I'd rather be wrong 1 out of 4 times than 3 out of 4 times, right? Or just guessing. I'm not really guessing. I'm predicting based on a statistical pattern. And this, because markets trend, this pattern holds true in any currency market, on any currency pair. Daily chart. Now, the further down you go in terms of time frame, if you look at an hour chart, it won't be as true. It will still to a degree trend, but not as nice as on a daily chart. So then as I was putting my strategy together, this was a really good basis to start from. Basically, the rule is never open a trade in the opposite direction of your daily prediction. Because that daily prediction is going to be 3 out of 4 times correct. Now, this is not the only rule. I mean, there are several rules that we're going to observe. But this is the first rule. If I look at a daily chart and I see this bar, green bar, guess where I'll be trading today? Next day, I'm going to be trading long, only long. I will only be taking long trades. Guess what? I could be wrong, but I don't really care. Because when I'm wrong, then I'll recover from that. But I will be 3 out of 4 times right. Guaranteed. Guaranteed. Right? So, now, something else. In the event that I am wrong, it doesn't necessarily mean that I will be getting into a trade. Because there is other set of parameters that will enter the picture. Okay? So this is the first step, and that's step 1. Determining the primary, I call it the primary direction of the day. That means questions. All right, so, yes, Dennis.
Just so I know, what makes the difference between the Heikin Ashi? I think we talked about this one time. Heikin Ashi and Japanese candlesticks.
Well,
Ashi bars are calculated. Like the candles are basically, Japanese candle is high, low. Let's just say that this is a dark bar, open and close. Heikin Ashis are calculated differently. They are much smoother. They take averages. So the open of a Heikin Ashi is open and close, open plus close divided by 2. So the Heikin Ashi bar will always open in the middle of the previous bar. And then the close of that bar will be open plus close plus high plus low divided by 4. Again, it's more of an average of what's happening within that, within the bar, as opposed to just exact movement. I don't really care about noise. I want to know which direction. So the Heikin Ashi bar would already open over here, and immediately, because it calculated this, and immediately it has open, close, high, and so immediately it starts painting whichever direction it wants to go.
Basically,
what do you know about the body and the width signify on a Heikin Ashi?
well, it's still,
Is it high,
this
low?
is still high,
Okay.
and this is still low. But the way the body is calculated is different. The Heikin Ashi always opens in the middle of the body of the previous candle. Right? So it is more of a smooth illustration of the price action as opposed to just high, low, open, and close. It will reflect more of really the trend within that day as opposed to just open price, close price.
Many times it doesn't close at its high anyway, it retraces and ends up.
That is true. But because of the way that the candles are painted, you know, as you notice, like on any one of them, a new candle starts in the middle of the body of the previous candle. There are no gaps on the Heikin Ashi chart, by the way. And gaps have a tendency to mess with your mind a little bit, right? So there's no gaps. And they are a better or a truer representation of what the market is doing. Anything that we do manually, we can do with the software, except much better and much more accurate. But in order for you to build an automated trading strategy, you have to understand how to trade manually. Because if you don't have a clue how to trade, how are you going to build out an automated trading strategy, right? So the whole thing is very, very, very simple if you know when to get in, how to get in, where your profit is, how to get out, and what happens, what to do when the market goes against you. There's nothing else to worry about. If you can do that, then game over. So we just try to have a solid strategy, and then with the software, we basically just let the software do it. All right, so this is the first step, basically determining the primary direction. We will never trade against the primary direction, ever, ever. If I see anybody break that rule, I will personally chop your fingers off. it's just insanity to fight the market, right? You can never fight the market. If the market is going this direction, please jump on that bandwagon and go in the direction of the market. Never go against the trend, no matter what. It doesn't matter what the indicators are telling you. It doesn't matter when I say what the indicators are telling you. I mean crosses and all that crap, that you see on the charts that just confuse people. I mean, used to confuse me. That's why I don't look at charts anymore. I've extrapolated everything that I found from the charts and put it in the software, and I only show it as an arrow, up or down. There's nothing else. Red is this way, green this way. That's it. Because that arrow already figured out, or took the confusion out of the chart, already translated what the chart is trying to say. Step 1, primary direction. Now, what are we looking at? We're looking at a 240-minute chart. You see the same type of prediction would work on a 240-minute chart as well, but not as accurately as on a daily chart. The daily chart is basically our Bible as far as determining the direction. That is what we go off of. If you want to be a lot more of an aggressive trader, you might want to use a 240-minute chart, which is a 4-hour chart. Now, you will be wrong more times. If you have good trade recovery, that will not hurt you. At certain times, though, being able to predict a market reversal will enable you to get out of a good trade faster, so you take more profit, and also will eliminate some of the wrong trades when the market is reversing. But at the same time, see, it's like a double-edged sword. At the same time, sometimes it will get you out of potentially more profitable trades later, right? So, I mean, that just if you were trading manually, it comes with the feel. You just gotta get the feel for it. But I just stick to a daily chart, and the daily chart determines my primary direction. Now, in this situation, based on the last candle, where would you be going? Right? Long, right? That's simple stuff. So, I'm saying daily or 240-minute Heikin Ashi. If you are an experienced trader, you've been trading for some time, you can use 240. If you're just a new trader, just stick to a daily. Now, step 2. So far, we haven't entered the market yet. We have only established which direction it will be going 75 to 80% of the time. Now, next what we have to determine is what I call the trend. It's a short-term trend. And I look at, basically, when determining the trend, I look at the slope of the 20-period EMA, also the last Heikin Ashi bar, and this must synchronize with the primary direction. And I would look at a trend on a 60-minute chart. And I want to look at the slope of the moving average on the 60-minute chart, and also the color of the Heikin Ashi bar. gonna trade when the primary direction on the daily chart, as well as the trend, the short-term trend on a 60-minute chart, are both in the same direction. So we're looking at multiple time frames now, right? We're confirming that the long-term direction as well as the short-term direction are both the same. Yes, sir.
So, daily chart, green candle, you're going to trade long. You go to the 60-minute chart, you're looking to make sure that the current price is above the EMA taken long.
Not necessarily, I'm not necessarily looking for the price to be above, but I am looking for the slope of the EMA to be in the same direction as my primary direction. So in other words, if my primary direction is up, I'm looking for an EMA that is sloping to the upside, as opposed to being flat or to the downside. And at the same time, I have to have the same color Heikin Ashi bar being the last bar.
On the 60.
On the 60.
So
That's my short-term trend. Yes, sir.
So you're saying the more that the slope is in position and you're looking at multiple times, the more greens you have, then the better chance of
Well, on the 60-minute chart, I'm looking for the last bar. If this was a 60-minute chart, I'm looking for the last bar, this bar, to be in the same color as on my daily chart.
But what about, what were you saying with the multiple time periods? Maybe
Well, when I say multiple time frames, that means that you do not trade only off of what you see on one chart, on a daily chart. You're using several different time charts to confirm that the price action is the same on several different time frames, not just one.
And what are the main time frames?
Here's I'll give you a different example. When you look at the market on a chart, you can specify what type of a time frame each bar on that chart should be or is to be. So you can be looking at a 5-minute chart, 60-minute chart, a 30-minute chart, 15-minute chart, daily chart, weekly chart, monthly chart. So in other words, depending on what the time frame of that chart is, each one of these bars represents one of those time frames. Price movement during that one period of time that the chart is reflecting. Right? So, if you're looking at a daily chart, the price might be moving up, or the bars might be green. But if you're looking at the very same security, or the very same currency pair on a 5-minute chart, you might see red bars. Yet it is the very same thing. Right? I mean, those of you that trade understand what I'm talking about. So, also when you open the DS matrix or even the trends window on the software, you will see that one currency pair might have across the different time frames different types of arrows. Some arrows are green and some arrows are red, right? So that only shows, those arrows show what the market is doing on that specific, that specific time frame, on that specific chart. So on a 5-minute it might be red, on a 15-minute it might be green. Well, it's still the same market. So which direction is the market going? Is it going up or is it going down? Well, it depends on which time frame you're looking at. So what I'm saying is, in order to be more accurate in your trade entry, you look at across several different time frames to make sure that those time frames are synchronized. Your entry point will be so much more accurate. So we are looking at the daily to determine the primary direction, and then we also look at an hourly to determine the short-term trend. What is happening within the hour? So let's go back. So I'm basically, I mean, yeah, it is good when the price is above EMA, but that is not necessarily or absolutely necessary if all the other parameters are lined up. So step number 2 again. We're looking at a 1 hour time frame, and we want to make sure that the slope of the moving average is pointing in the same direction as our primary direction, or the last completed Heikin Ashi bar on the daily chart, and also the last fully completed Heikin Ashi bar on our trends chart, which would be a 60-minute chart, is of the same color. So in other words, daily and hourly are synchronized. Yes, sir?
Quick question on the 20-minute EMA slope. You want to match, is the slope of that EMA on the daily or the
slope of EMA on the daily doesn't matter.
Okay, so only on the 60.
Only on the 60-minute. On the daily, don't matter. Because the daily, you're looking at the last completed bar. If it is green, you go long. If it is red, you go short. But not at all cost. Only if all the other conditions are met. The other condition, or the second condition, is basically on the 1 hour chart, the direction is synchronized with the daily chart, right? When I look at the daily chart, I just ingrain that into my head like this, and if I see a green bar, I'm not even thinking short trades. I'm not even thinking. I automatically, we're only looking for opportunities to go long term. Yeah. So now, here's the 60-minute chart. Every bar represents price action during the respective 60-minute time period. So here we are at the very end. This was the last bar. This is the current bar. Obviously, if we had the daily bar green, which way are we trading? Obviously on. Look at the slope of the EMA, right? And right over here, somewhere during this bar, would be my entry.
EMAs are always lagging. We know that, right?
Absolutely.
Taking the average of how many candles or
Yeah.
something. When you were putting this together, did you take into consideration of that, the fact that you're going to be late in a lot of trades?
Well, absolutely. You're always going to be late, but it's all about the statistics. You know, you will never be able to pick unless you're guessing. And, you know, if you make 100 guesses, maybe once, twice, you might be right. But you will never be able to pick the very tops and the very bottoms, simply because when the true reversal in the market happens, all the indicators are showing the opposite direction. When the market reverses at the very top or at the very bottom, all the indicators show the opposite direction. So you can never pick it. Why try? I will go on statistics, and my statistics are better, you know, to pick the direction of the market when the market has already established which way it wants to go. I don't like to guess. And trying to pick the bottom, that's just guessing. Right? Or the top. Now, we do that when we take profit, because when in profit, take it. You know, when you have a profit and in doubt about the market, take the profit. That's no question. Because there will always be another opportunity to get back in when all the conditions are met. But you know, getting in, you know, like I wouldn't be getting in here, even though this would be a pretty good setup. But I have the slope is kind of going down, right? So I'm getting in here. Yeah, I missed this opportunity or missed this potential. But guess what? My probability, long-term statistics are better here. Because many times, this could go against me. It's just like the Heikin Ashi on the daily chart. You know, I'm not right all the time, but 3 out of 4 times I'm right. So I'm not going to try to be right 100% of the time. Because if I tried that, I would probably be wrong 3 out of 4 times. So we've got step 1, step 2. We still haven't entered the trade though, because you can hold this present. All the conditions are met. Right? So if you're using a daily chart to determine the primary direction, you also will be using an hourly chart or 60-minute chart to determine the trend. They have to synchronize. When they are both in the same direction, now you get ready to trade. Now you're almost ready. When you are using a 240-minute chart to determine the primary direction instead of the daily, then you would use the 30-minute chart to confirm the short-term trend.
We go 2 times frame low.
Well, what is a time frame?
On a typical chart.
You could have a 57-minute chart. You could have a 45-minute chart. So you could have those time frames any way you want to. But generally speaking, the difference should be at least, you should be able to fit the smaller time frame at least 12 times into the bigger time frame. Right? All right. So we've got a similar situation over here. Now, I don't have to tell you that this is a setup for a long trade. The slope of the EMA is up. Color of Heikin Ashi is green. Price is definitely above the moving average. That's a long trade setup. Now, step 3. This is the last step. There's only 3 steps in entering a trade. Now, when your two time frames, two charts, are matching, are synchronized, then you're looking for an opportunity to enter the trade on a yet smaller time frame. Now, I personally don't necessarily look for a time frame per se, but I'm looking for movement in the market. And I find that on either a range chart or a Renko chart. Here's why. The currency markets trade 24 hours a day. And as we all know, there are times when they are more active and other times when they're just dead. Sometimes it's the other way around. Sometimes when you expect them to be completely dead, they're active, and vice versa. So what is important to me is the movement in the market, not necessarily the time frame. Because I don't make money on time, I make money on price movement, on the volatility. So what I would look at is not necessarily a time chart, but a volatility chart. Who is familiar with a Renko chart? Renko bar. A range bar as opposed to a time bar. Well, a time bar let's just draw a candlestick over here. Right one. So a red candlestick, and let's just say this is a 5-minute bar on a 5-minute chart. This is the lowest price during that 5-minute time frame. This is the highest price that the market reached. This is where it opened. This is where it closed. This happened during 5 minutes. And this would appear that this market would be fairly volatile. I mean, there's some movement over here. But many times you have bars like that. And this will go on for hours. Well, this doesn't do much for me because I need price movement, right? So I will not necessarily use a time chart. I will use a range chart. And on a range chart, what really happens, a bar will only be painted when the market has moved a certain number of pips, right? So if I'm looking at a range chart, or let me just do it over here. Let's just add a few more bars. Like that. Let's just assume that from here all the way to the high over here, this would be 10 pips. Right from here to there. This is 10 pips. Now, this market took 5, 10, 15 minutes. It took 3 bars the chart painted 3 bars while the market moved only 10 pips. Now, a range chart would, if it was a 10R or 10 range chart that measures ranges, and if I was looking for a 10 pip range, then I would only see 1 bar for all the bars on a time chart that it took for the market to move 10 pips, right? So I'm looking for the movement as opposed to the time. Because sometimes it will take hours for one 10 pip range bar to be painted, while on a 5-minute chart or 15-minute chart, it could be 20 different bars or 20 bars. That is just, to me, that's just too much noise in the market. And I don't necessarily want to enter the market when the price is not moving. Right? Similarly, on a Renko bar is very similar to a range bar, but it measures the distance the market moves above or below, above the last high of the previous bar or below the last low of the previous bar. And that's your homework, to figure out, to look at Renko bars and range bars. Now, obviously you can still use a smaller time frame, like a 5-minute or 15-minute. There really is nothing wrong with it, but I prefer, my favorite is a Renko bar. I just can't help myself. But not just the Renko bar, but the Renko Heikin Ashi bar. So I married the Renko chart with Heikin Ashi. That is my trick. That's how I enter the market. So, what are we looking at? Step 3 is basically of our entry setup. Step 3 is the actual entry, the actual opening the trade, clicking on the left bounce button, either buy or sell. This is when we're entering the market. Number 1, our daily chart is determining the primary direction. Our 1 hour or 60-minute chart is determining our short-term trend. And then a smaller time frame chart is actually showing us or giving us the actual trigger or the entry point. Last Heikin Ashi range or Renko bar is synchronized with step 1 and step 2. That's pretty simple. In other words, I'm looking at a smaller time frame when my first 2 steps are confirmed. Step 1, step 2, first 2 conditions are confirmed. Then I'm looking for some type of a confirmation on a smaller time frame chart. Either a 5 pip Renko or a 10 pip Renko, depending on the volatility of the market. If I were trading euro dollar, I would be looking at a 5 pip Renko bar. If I was trading pound yen, I'd be probably looking at a 10 pip Renko bar. That is also a Heikin Ashi bar. When it turns green, guess what? I'm in. That's it. Because I have confirmed my 1 hour direction or 1 hour trend daily direction. I'm going to be right 3 out of 4 times. If I'm not, so what? I'll take another opportunity. Or I'll reverse, or I will recover. one of those things will happen. Yes?
So the DAT always looks at these three things.
Forex DAT?
Yeah. I mean, it looks at more. But it always looks at these three.
Well, Forex DAT, as the software itself, doesn't really look at anything you don't tell it to look at. Whatever you program or whatever you set, look at Forex DAT as a box of Lego blocks, right? So you've got a brand new box of Lego blocks. What you build out of it is up to you. You want to build a bridge, or you want to build a building, or you want to build a locomotive.
More specifically than the 6 strategies that you would put up for a watch, use.
They all have a variation of this, each and every one of them. Absolutely. So the triggers all and conditions, confirmations, contingencies, all those things are found in the PS matrix and are part of the advanced management in the software that drives the trading algorithm. Yes, absolutely. Yes.
So until we learn all of these things, it's actually already programmed for us if we choose to allow it.
If you choose a strategy that's already been set up, then yeah, this is all already set up in the software. But it is good for you to know what is going on.
So once you chosen your trade, you made your entry, now you're just going to watch it till you break it down.
Right. So once I'm in, now I'm watching to see if the trade reaches my profit target or if it goes against me. There is no other option, right? No other option that I'm interested in. I either make money or the trade goes against me. If I make money, I take the profit. If the trade goes against me, well, I need to put my thinking hat on and try to figure how to recover from that. My only other option would be to take the loss. But guess what? If I were taking a loss, that means that taking a loss is part of my strategy. Guess what? I've been caught in that situation over and over and over, and I hate to tell you what the final outcome will be. See, when you have a trading strategy, it's the same thing you keep repeating over and over and over. That's a strategy. You stick with it. Stick to it. You will not be right every time. But most of the times you will. So what have we established? Our trade entry has 3 steps. Step number 1 is determining the primary direction, which is nothing more than our prediction based on certain statistical data. Right? It's all statistics. If the market repeats the action of the previous day 3 out of 4 times, it'd be silly not to use that to your advantage. And that's exactly what happens. Sometimes 4 out of 5 times. Right? So, 1, determining the long term. When I say long term, I'm thinking daily. Because day is a long time. A lot of things can happen during a day. So that's my long-term primary direction. Then I want to determine my short-term trend. My short-term trend, I look at a 60-minute chart. And that 60-minute chart has to confirm or be synchronized with the daily chart. When those 2 things are in place, then I'm looking for the point of entry. And the point of entry I'm going to do on a much smaller time frame, maybe a 15-minute, even a 5-minute, or better yet, on a Renko or range chart. 5-tick Renko chart or a 10-tick, depending on the volatility of the currency pair you are trading. if you were trading, say, euro pound, where the average daily range is, say, 50 pips or less, then obviously you are not going to be looking at a 10 pip Renko bar because it might take half a day to paint one of those, right? You might be looking at a 3 pip Renko bar or 5 pip range bar max. Because you want to, everything else is lined up. Now you're just looking for that trigger just to get in. If you were trading pound yen, where the average daily range is 150 pips or more, sometimes 200, then there's a lot of noise. In a volatile market like that, there's a lot of noise, a lot of movement that doesn't mean anything, but it goes, pound yen can move 20 pips inside 30 seconds, right? So you want to look at least a 10 pip Renko or range bar, right? Now, and when all of those are in sync, that's when you pull the trigger. That's it. Now we're in a trade. Now we've got a trade open. It's simple. Do not read more into it than that. Here's what doesn't matter. Here's what really doesn't matter when you're trading. It doesn't matter what the non-farm payroll data is. Doesn't matter. You know what matters? The price matters. Price matters. Doesn't matter what the University of freaking Michigan consumer or whatever that BS crap is. Doesn't matter. They don't even know what it means. And it changes all the time.
It's always revised anyway.
I'm sorry?
It's always revised later anyway.
Yeah. It doesn't matter.
You got it?
You know what really matters? The price. Doesn't really matter if you're thinking this market is going to paint a head and shoulders on a daily chart or 1 hour chart or a 300-minute chart. It doesn't matter. None of that matters. Don't get caught in all these nonsense, confusing things, because they will do just that, confusing. They were confusing me for years until I figured out none of that matters. So now we're in, right? So we're looking at a 10-tick range chart. Every one of these, basically every one of these bars is basically from top to bottom. You will notice that for the most part they are about the same. On a Renko bar, it won't be like on a range bar, but a 10-tick range bar, from top to bottom, they're about the same distance because they're 10 ticks. Now, we have established the daily is up, the hourly is up. We're looking for an entry. So stay with me, and you can see those. If you want to use a MACD indicator, now this is trading manual. This confirms your entry. You can. But I say this is not really all that necessary, because you've got the long-term direction and the short-term trend already established. You're looking for the first opportunity to get in. So when you see this first green bar over here, you're entering on the next bar. Now, one other thing. You always want to wait until the bar gets completed before you act on it. You never pull a trigger in the middle of a bar. Or just because a bar, say a 60-minute bar, is green for the first 30 minutes, doesn't mean it will remain green at the end of the 60 minutes. It's like the Broncos against the Patriots last time they played. You know, the score at halftime doesn't mean anything. You have to wait until the last whistle is blown. So in other words, in trading, it is when the bar is completed and the new bar starts. That's when you're looking at always the previous bar. Right? So here's an entry. It's actually confirmed over here because you got the green line of the MACD above the red line or purple line. Right? So that's confirmed there. Now the market's going up. This would have been one of your entries. All right. So that's just as simple as I can put it. There's nothing really more to it. Now we're trading. We're in. So obviously these are the setups for a long entry. Now here's an important thing. And one of the biggest mistakes why people sometimes have no other option but to take a loss. And that's the fact that they put on too big of a trade or a lot larger of a trade than they really should. And the nature of the leverage and the fact that you can control a $1,000 trade with what? I'm sorry? $20. Right? You can control a $100,000 trade with $2,000, right? So people with a $10,000 account, they're thinking, I can trade a lot more because I have the capital to open the trade. But they don't realize that when the trade goes against you, you don't necessarily have margin left to do the recovery. It'd be the same thing as, you have $10,000 in your bank account and go spend it all on a $12,000 car. That leaves you with no money left in the bank account, right? So the idea is here's how I look at trading. I do not want to put any more than 10% of my capital in all of my trades. In all of them, 10% of my capital that is available, I do not want to have any more tied up in margin. So that being the case, if I have, let's just take $10,000 for an example, I do not want to have any more than $1,000 of that $10,000 tied up in trades. Right? But if I know that the $1,000 is the most I'm going to allow myself to put into a position, I will not start putting in $1,000 right away. I'll split that in 5 parts. 5. 1, 2, 3, 4, 5. And my first entry will be only for 1/5 of what I think my maximum should be. Now, why would I do that? Well, I'm kind of, setting myself up for a good trade, but I always assume the worst.
Just in case.
I always assume I'm going to be wrong this time and the market's going to go against me. Well, when the market is going to go, and I'll give you an example. Let's suppose that I entered the market here, right, on this bar. After market right now, it's retracing a little bit. Now I get a clear signal, green bar. My MACD still is confirming the uptrend. And guess what? Well, market drops off. Right? And I've got all of my chips on the table. Then what do I do now? Typically what people do, they pray. That's what people do, they pray. And if praying doesn't work, then they have no choice but they gotta get out with a loss. Right? But the markets oscillate. They go up and down and up and down. And guess what? I was wrong here. But here's another opportunity again. If I have capital left, I will improve my cost basis and enter again here. So I'll add to my position, and now my loss on the aggregate position that I have is a lot less in terms of pips than it was when I first entered, because I'm dollar cost averaging, right? So what if I'm wrong again? Guess what? I can go in third time, and I still have margin left. On the third opportunity, guess what? This would have been a clear winner. So here's something to consider. Now you only do this when all the other conditions are in place. When conditions change, you do not add to a position where the conditions have changed, either on the 1 hour chart or the daily chart. Right? But if the conditions remain the same, you can add to that position. And here's a simple illustration of how this works. Let's just say we're trading euro dollar, okay? And we're going long. And the price is at 13000. That's the price. We enter long. That are very small, just our first part of the 5-part trade, if you will, right? If the market goes in our direction, great. We make money, we take the profit. Now the market goes against us. Let's just say market drops to 1.2800. We get another opportunity to enter here. So for the or for simplicity, let's just assume that we entered one mini lot here and another mini lot here at 12800, both longs. Now the question is, what is our average price on the combined position? 129, right? So at 129, even though the price is at 128, and we are 200 pips down on the initial trade, but on the combined position, guess what? We're only 100 pips down. Now, suppose the market still goes down another 200 to 12600 and gives us another opportunity to go long. And we still have margin available to us. We only used up 2/5 of what we had allocated for one position. Now, we add another one. What is our combined cost basis on this entire aggregate position? Even though the market dropped from our original position, market dropped 400 pips, but we're down only 200. See? Now the market reverses. This market might never come back here again. But if it moves up 200, we have completely recovered our loss. Whereas most people would have probably been out here with minus 100 and out here with another minus 100 and all frustrated, crying. We actually broke even, or maybe made a little bit of money. And most people just don't get this. They go in, they go all in, like in poker, all in on every trade. And then they have to get all out with a loss. So it is very important how you manage your margin. Just because you have money available doesn't mean that you're going to put it all in that initial trade. Now, when you get a little more advanced, then you'll be looking at triggers or entries on different time frames as well. You'll be looking at 5-minute, 15-minute, 30-minute, Renko, range, all of those. And you'll take every opportunity for entry. And by doing that, you will actually improve your odds of having, first of all, better cost basis and better odds of one of those triggers being actually correct. Yes.
Okay, so that first trade that's going against you, you don't close that trade out. You let that trade just go on.
When you say close the trade, I will only close a trade when it's in profit. So if it's not in profit, I don't know what it means to close a trade. Because that would mean to take a loss. Right? I don't know what it is to take a loss. I don't understand. No comprende. I don't know what that means to take a loss. It's not in my vocabulary. It is not part of my trading strategy, period.
So if I'm understanding, that's the whole point of breaking your investment into fifths. So you have the funds for the recovery, not the take loss.
Exactly.
Okay. Just wanted to make sure.
Exactly, because here, worst case scenario, I could go down, a couple more times like this. Now, this is an unrealistic scenario in euro dollar. Who can tell me why? Because by the time this market moves 400 pips, all of the conditions on the hourly chart and possibly on the daily chart have reversed. This market is completely going. I wouldn't be even entering here because the market doesn't give me the opportunity to do it. By this time, I am trading short all the way down. I'm taking profit going short, and I have this position hedged. Yeah, but this is just an illustration of how the money happens. Yes, guys.
When you said about losses, that's only if it's not part of the sequence. You do take negative trades, but in the big picture, there's still
in the big picture, I mean, I create additional. When I start a trade, when I open my first trade, when the slate is clean, and this is my first trade, now I have a trade. That is nothing more than the beginning of a potentially long trading sequence. Now that trading sequence might be 2 trades, might be 50 trades, or might just be that one trade. But when I close all the trades, when there's nothing left on the table, trust me, I will have a profit. There will not be, there might be, yes, some losing trades, because here's the thing. If you break these trades down, let's just say that the market comes back to 128.10, right? The market comes back to 128.10. How many pips did he make?
210 plus 6.
How many pips altogether?
minus your 90 to loss.
We made 10 pips on 3 minis or 30 pips altogether, right? When this market comes back to 128.10. Well, how was this broken down? Well, on this position, we actually lost 190. Right? On this trade, we lost 190. On this, we made 10. And on this one, we made 210, right? Add them up. 30, right? So, yes, I did have a loser if you look at just this trade isolated. But I don't look at this trade as an isolated trade. I look at this whole thing as 30 pips in my pocket.
Since you go by probabilities, as the market goes deeper and deeper, the probability of retracement is higher. Why do you break it up into even as opposed to increase?
I don't agree with you.
You don't agree that the probability that it's going to retrace, there's going to be more retracement?
No. No. It will once I have a daily candle, which is the other color. Then, yes. But if the bars are the same, I don't care. There is no statistics that I have that tells me the further the market goes, the more likely it is to reverse. I would think, on the contrary, the opposite is true. Until something happens and then it reverses. But then when it reverses, luckily I am not colorblind. And I look at the colors, green, red, green, red, green, red. I don't think of anything else. I don't try to pick the tops or the bottoms or outguess the market. Who am I to say that the market is about to reverse? I don't know. I can predict with 75% probability when the color changes, after it reverses. Not before. Never. I don't try to do that.
The open, what my question is this. That one open trade that you start out with will continue to be open until it goes into profit, which means
that trade itself, in and of itself, doesn't necessarily have to go into profit, that specific one trade. But other trades will be opened that will cause for the combined position to be in profit.
Now, my question in regard to that is, you said it could be 20, 30, 40, whatever. If you had an account, what is the probability of exhausting a lot of your account trying to actually correct the first trade going the wrong way? I mean, those trades taking place, is there some type of bond?
You want a realistic answer?
I want a realistic answer.
0. The probability of me exhausting my account is 0. Because I will never open a trade that is large enough that on a small move would wipe out my account. Ever. Never. By the time the move becomes long enough that it could endanger my account, I will have reversed my position and be trading in the direction, in the new direction, in the opposite direction.
That's huge. That's what that's huge.
Yeah.
Okay, just like over here. We're assuming this market is going to drop 400 pips. Yeah, theoretically it can, but practically I will never be sitting there doing nothing and letting this market drop on me like that. I will be long before it reaches here. I will be in there short and taking profit in the opposite direction, which will offset the loss of these trades. And when the market reverses, then I'll be back in going up.
What if that happened in one daily bar, a 400 pip drop, even though your signals previous to that were
well, there are hourly bars, right?
Yes.
Right? So I will be hedged by the time the bar changes on the daily chart, the bar changes color. I'll be hedged long before because I'll be hedged on the hourly bar.
First hourly change of direction, or do you have
Absolutely. Okay. If I'm not in profit.
Okay.
If I'm in profit, I take the profit and then I just wait for the next opportunity. Either my original direction gets reconfirmed or there's a reversal. Nothing else will happen. If there's a reversal, I'll be trading the other direction. If the original direction is confirmed, I'll be back up in the market again.
And is that partial hedge or full hedge if it's dependent?
Full hedge.
Full hedge.
Or on a zone recovery, it will be higher, or the position on the zone recovery will be larger than the original trade. Yeah.
Realistically,
Yes.
person has $1,000.
Everything I say is real.
All right, this question might be different. But person has $1,000. They're going to trade only 10% of it, which is $100. They're going to divide it up into fifths, which is $20. Realistically, can a person take $20 and turn it into $1,000?
Well, don't quit your daytime job while you're trading a $1,000 account, but theoretically it is possible because they'd be trading micros, right? So you've got one micro that's basically $20, right? Yeah, but $20 gets you gains 20, 40, 60, 80, 100. You could do it, but
Joseph, when we talked, I asked you that same question because of other people who made budgetary constraints. What would we talked about? You mentioned probably 2,000 kind of being a threshold to be able to make it work.
Here's what: if you have to trade with one micro, there is no smaller.
Right.
You cannot break it into 1.2 micro. So you should at least have a minimum $2,000 account, because that's when you would trade 2 micros and you can still have a split, 1 and 1 equals 2. If you have to go into recovery, because the recovery is, especially in the zone recovery, it's always a different number than your original trade. And I'll show you how that is. Right? So this is the trigger. This is the entry. Now, and we discussed the 1/5. We know 1 now, right? Absolutely. Now here's a very similar situation. This was looking for entries or triggers on a 10-day grain chart. This here is Renko chart, and it's basically the same chart. See how the Renko chart shows the trending patterns. It's pretty nice, right? Yeah. I mean, when you catch a trend, you catch a trend. All right, so this is pretty obvious, right? I'm looking at a 5-day Renko chart. My hourly and my daily are all lined up. Guess what? 1, 2, boom, I'm in. Confirm on the MACD if I want it confirmed. Theoretically, I could enter right here. Market goes against me. Then my next entry would be right here. And our dollar cost average probably right about here. I mean, I'm breaking even. That's a good one. Next entry. Right there. Now, for your confirmation, for you guys, manual traders, you could use a CCI, Commodity Channel Index indicator. You could use, what other ones? Stochastic, yeah. It doesn't really, they're all pretty much the same. Yeah. They're just calculated differently, but for the most part, they're the same. I like CCI too. I like stochastics for confirmation like this. But now, obviously, I trade everything with an automated system, so it doesn't really matter. Because when the stochastics and the RSIs and the MACDs and all those point to the downside, I get red arrows. When they point to the upside, I get green arrows. I just look at the arrows. That's all. We'll go through this. No, very far. All right. So obviously, we're looking for long trade signals here. And again, same thing applies. So whenever you think that you have enough capital to enter into a trade, you should cut that by 80%. Divide that by 5. That should be your trade.
What do you mean by that?
That will basically, I'm reiterating what I'm saying over here. When you think that you can afford to get in the market and open a $1,000 trade, think 1/5 of that. 200. You'll be glad in the long run. Trust me.
Just going to stop. So where's your maximum risk?
You know what? I never really looked at that, to be honest with you.
Your position sizing is all about the
I'm sorry?
Your position sizing is out.
No, it isn't, because I recover and I hit. All right, so look at it. Let's go back and look at the $10,000 account. Okay? So my initial position would be a $200 margin, which would be what? 1 million. 1 million. So every 100 pips that the market goes against me is $100, correct? So in order to wipe out a $10,000 account, that market would have to go against me on that position 10,000 pips, right? That's a long range. That's a long.
You could get in a range where you could be wrong over and over and over and over and over again before it starts to trend again. You could multiply 10, 12.
Well, but then that means that the market is not dropping very far away from me or not running. If it is in range, then that position that is supposedly in the red is not going that far in the red if we're in a range. Well, it would have to be a 10,000 pip range for me to get wiped out.
Yeah, you have the discipline to only bet $20. It's like,
well, that's what trading is
You
about.
have to keep your
Well, that's what the
trades
software
really
is
small.
for.
You have the account size. That's
Well,
the key.
of course it is. That's what we're learning over here, that don't go all in on the first trade.
Right.
That's how you don't wipe your account out. You still make good money, but you are disciplined to manage your margin in a way that theoretically, of course, the market could drop 10,000 points tomorrow, right? I mean, theoretically, could it happen? Yeah, I suppose it could. But practically, because by the time the market is, or by the time market has run away from you, you will already be trading in the opposite direction. By the time the trade runs away from me 300 pips, I will be out of that trade by having that trade zone recovered or hedged out of it. We haven't gotten that far.
That's sort of key.
That's the trade recovery aspect. If you don't have that, you shouldn't be trading in the first place. Doesn't matter what type of, how big a size position you put on. If most people simply do not know what trade recovery is, let alone have it as part of their strategy. All right, here's how my screen would look. Right here daily. Guess what I'm looking at? I'm looking at this bar. Right? This bar has determined my day. If today stays like this, guess which way I'm going to be trading tomorrow. Long, right? Right? Now, some people will look at this and say, well, this bar did not get over the high of the previous day. So it might be ready for reversal. But I don't really go by that. I don't care. I don't go on might or could or should or the market is crazy. The market is crazy 90% of the time. It's irrational. And one thing to remember is that the market has the ability to be irrational a lot longer than your trading account can handle if you're not disciplined, right? So I don't do any guessing. My mother calls me a gambler because she doesn't understand this. But I'm the last from a gambler. Last thing from a gambler. You will not see me walk into a casino and spend 5 cents on a game of chance. I would be shaking like this. I'm not a gambler. I play my odds, and this is just simply statistics and knowing what to do if things go against you. Right? So here we are. Here's our 1 hour trend. Look at this. There's a slight green. You see it? Almost like a doji. Those of you that study candlesticks know that a doji at the extreme, or at an extreme, can indicate a reversal. Right? So, a green doji, slight pot, that's good enough for me. I'm ready to go long here. And now, over here I'm looking at a 5-tick Renko chart. Here's my entry. Pretty good one. And the chances are down here somewhere, which is off the chart, to go to the left, there would have been another one that I exited Renko.
Except for you'd be looking at the far edge.
Well, of course. I mean, I only know this with the benefit of hindsight, of course. But, you know, the chances are that this MACD was up. So somewhere in here, the chances are there might have been an opportunity to get it before this one. The next one would be where? Well, we get out here. Our MACD is falling. We don't really have an opportunity yet. Right? So, now, let's summarize. Our first part of our strategy, which is trade entry. And here's our setup. Daily or 240-minute Heikin Ashi chart. What's the last completed bar? What's the color of that bar? Blue means what? There are no blue bars. Testing to see if you're paying attention. Green bar means what? Next day, 3 out of 4 times will be going up. Red bar, 3 out of 4 times, next day will be down. So we've got that. That's our mother of all indicators. Right? Daily. Next. Trend. On a 60-minute chart, we're looking at the slope. Which direction the EMA? Doesn't have to be EMA, guys. Could be SMA. Doesn't matter. You're just looking at the slope or angle, right? If it's going up with a green daily bar, that's good. Then they're synchronized. They're lined up. With a daily red bar, the slope of the 20 period moving average should be down. If it's not, we're not trading. So this is one of those times where you could actually be wrong on the daily prediction. Your primary direction might be wrong, but the other 2 steps of the setup will not allow you to enter that trade. Right? Because there's different time, it's basically a multi-time frame strategy. Okay. So, but if the slope is up, Last Heikin Ashi bar is green. Setup is correct, right? Now we're looking for what? The trigger, entry. And we're looking at either a range chart, Renko chart, say 5, 15-minute chart, 10-minute chart, any of that works. Because you already have the two higher time frames lined up, and you're looking for the trigger to basically jump in. Open the trade. So basically, last Heikin Ashi, range, Renko, 15-minute or 5-minute, is synchronized. When I say synchronized, it means the same color as the step 1 and step 2 bars. Optional, confirm with MACD, CCI, stochastics, if you want. That's it. That is it. Nothing more to it. Other than, right? Your first trade should only be 1/5 of the position you think you could take. Right.
That's some serious discipline.
That's it. That's it. No more. We've got 1/3 of the entire strategy. Some people spend 10 years trading and don't know this. Right? We just cut all that BS out. Just focus on what is important. Nothing else matters. Nothing. All right. Now, using this simple 3-step multi-time frame setup will give you a 75 to 80% trade entry accuracy. And 3 out of 4 times, 4 out of 5 times, you'll be taking profit. No brainer.